March 15th, 2023, a TV reporter asked one question that helped kill a 167-year-old bank. Credit Suisse was already wounded by scandals, lawsuits, client withdrawals, and collapsing trust. But when Amr al-Qudairi, chairman of Saudi National Bank, was asked whether his bank would provide more money if Credit Suisse needed it, he gave an answer that was only 2 words long in meaning, but deadly in effect. Absolutely not. Within hours, panic moved faster than any rescue plan. Those 5 words landed like a hammer. Credit Suisse shares plunged to record lows, falling by roughly a quarter in a matter of hours. Credit default swaps, the cost of insuring the bank's debt against default, surged to crisis levels. Investors were no longer asking whether Credit Suisse was cheap. They were asking whether it could survive. And once a bank's clients start asking that question out loud, the problem becomes bigger than accounting. It becomes a race against fear. The timing could not have been worse. Just days earlier, Silicon Valley Bank had collapsed in the United States, putting global markets on high alert. But Credit Suisse was not a regional tech bank. It was one of the world's global systemically important banks, with around $1.3 trillion in client assets. This was supposed to be a fortress of Swiss finance. Yet in the final days, money was reportedly leaving at around $10 billion per day. Swiss authorities tried to stop the panic with an emergency liquidity line of roughly $54 billion. But liquidity cannot repair trust once trust has already broken. A central bank can lend money. It can calm headlines for a few hours, it can buy time, but it cannot force wealthy clients to stay inside a bank they believe may fail. Credit Suisse did not die because of one interview. The interview simply exposed how fragile the bank had already become. To understand the collapse, you have to go back to the beginning. Credit Suisse was not founded as a casino for traders. It was founded in 1856 by Alfred Escher, a powerful Swiss politician and industrial visionary. At the time, Switzerland was not yet the polished financial paradise people imagine today. It was mountainous, fragmented, and trying to industrialize. Escher believed the country needed railways, tunnels, electricity, and national capital, so he helped build the bank that would help build Switzerland. The original bank was called Schweizerische Kreditanstalt. Its purpose was practical and national. It helped finance the Swiss Northeastern Railway, supported major infrastructure, and later became tied to projects that connected Switzerland to Europe. Credit Suisse was not just moving money around balance sheets, it was transforming debt into credit, credit into infrastructure, and infrastructure into national power. The bank became part of Switzerland's identity because it helped turn a difficult geography into an economic advantage. For decades, the image was stability. A Swiss bank meant safety, discretion, discipline, and permanence. The country's banking secrecy laws, formalized in the 1930s, turned Swiss banks into private vaults for global wealth. Foreign elites, corporations, and wealthy families trusted Switzerland because it promised confidentiality. Credit Suisse benefited from that aura. It became more than a bank. It became a symbol, the mountain vault where money could hide from chaos. But stability can become boring to ambitious executives. By the late 20th century, quiet private banking was no longer enough. Wall Street was making huge money through trading, leveraged finance, takeovers, and complex markets. Credit Suisse wanted a bigger role in that world. It partnered with and later acquired First Boston, an American investment bank. This was the turning point. The conservative Swiss institution began absorbing Wall Street's appetite for speed, leverage, and risk. The shift changed the bank's culture. A firm built to preserve wealth was now chasing investment banking glory. Leveraged buyouts, mortgage products, capital markets, and high-risk deals pulled Credit Suisse deeper into the American financial machine. The profits could be enormous, but so could the damage. This is the first major lesson of the story. When a conservative institution imports a high-risk culture without controlling it, the danger does not appear immediately. It compounds quietly. Credit Suisse survived the 2008 financial crisis better than some rivals. But survival did not mean the culture was healthy. Under the surface, scandals kept building. In 2014, the bank pleaded guilty in the United States to helping wealthy Americans hide assets offshore. It paid $2.6 billion in penalties. For a bank whose brand was built on trust, pleading guilty to a felony was not just a legal problem, it was a crack in the myth. Then came Mozambique's tuna bonds scandal. Credit Suisse bankers helped arrange more than $2 billion in loans supposedly tied to a tuna fishing fleet and maritime projects. But the money was surrounded by secrecy, hidden debt, bribes, and kickbacks. When the debt was exposed, Mozambique's economy was hammered, foreign aid stopped, and ordinary people paid the price for elite financial engineering. What looked like clever international finance became a national disaster for one of the world's poorer countries. Each scandal should have forced deep reform. Instead, Credit Suisse kept moving from crisis to crisis. The bank paid fines, replaced executives, issued statements, and promised change. But the pattern stayed alive. Something inside the institution had learned to treat scandals as manageable costs rather than existential warnings. And that is how giant companies rot. Not all at once, not from one decision, but from 1,000 moments where the system protects revenue before reputation. In 2019, the scandal became almost absurd. A top wealth manager, Iqbal Khan, left Credit Suisse for its rival UBS. The bank feared he might take valuable clients with him. Instead of handling the problem quietly, Credit Suisse hired private investigators to follow him through Zurich. The spying operation became public, exploded into headlines, and damaged the bank's reputation further. A bank that was supposed to protect secrets had created a tabloid spy scandal in its own backyard. Spygate revealed a deeper problem: paranoia. Credit Suisse was losing not only money but confidence in itself. Strong institutions do not need to tail former employees through city streets to prove they are secure. Weak institutions overreact because they sense clients may leave. The scandal led to resignations and reputational damage, but the most tragic part was the suicide of a private investigator connected to the affair. The story had moved beyond finance into institutional breakdown. Then March 2021 delivered 2 body blows in 3 weeks. First came Greensill Capital, a supply chain finance company connected to Credit Suisse funds. When Greensill collapsed, around $10 billion in client funds were frozen. Clients had believed they owned safe products. Instead, they were trapped in a messy credit disaster. For a bank built on wealth management, this was devastating. Rich clients can forgive weak returns. They do not forgive being locked inside products they thought were safe. Days later came Archegos. Bill Huang's family office had built huge leverage positions using derivatives. When the trades turned against him, banks rushed to protect themselves. Some rivals moved quickly and dumped exposure. Credit Suisse hesitated. The result was a staggering loss of around $5.5 billion, wiping out an entire year of profit. This was not a small operational error. It showed the market that Credit Suisse's risk controls could fail at the worst possible moment. Greensill and Archegos were not just losses. They were trust destroyers. Clients wondered how the same bank could be caught in 2 disasters so close together. Regulators questioned controls, investors questioned management, employees questioned leadership. The Credit Suisse brand had always depended on the idea that the bank understood risk better than outsiders. Now, the evidence suggested the opposite. The fortress did not just have cracks in the walls, the guards had fallen asleep. By 2022, the reputational damage deepened again. The Swiss secret leak revealed accounts connected to criminals, corrupt politicians, and other controversial clients. For any bank, this would be ugly. For Credit Suisse, it attacked the heart of the brand. Swiss secrecy had once been marketed as discretion for the wealthy, but now secrecy looked less like stability and more like a hiding place for dirty money. The old strength had become a liability. Then social media added fuel. In October 2022, rumors about Credit Suisse's financial health spread online. The bank tried to reassure clients, but reassurance sounds weaker when it comes from a company already surrounded by scandals. Wealthy clients began pulling money. In the fourth quarter of 2022, client outflows reached about 111 billion Swiss francs, roughly $119 billion. For a wealth management bank, this was like oxygen leaving the room. This is the difference between a normal company and a bank. A normal company can survive bad headlines if customers still buy the product. A bank survives only if clients believe the money is safe. Once clients withdraw deposits, move assets, and question solvency, the business model starts eating itself. Credit Suisse still had a famous name, it still had global reach. But the invisible asset that mattered most, confidence, was disappearing. By early 2023, Credit Suisse was trying to sell a turnaround story. New leadership promised restructuring, job cuts, risk reduction, and a cleaner future. But the market had heard promises before. Every scandal made the next promise sound weaker. Every outflow made the next presentation feel more desperate. The bank needed time to rebuild trust. But banks in crisis rarely get time. They get questions, withdrawals, rumors, and one unexpected headline that can turn pressure into panic. The endgame arrived in March 2023. Silicon Valley Bank failed in California, and suddenly investors looked at every weak bank differently. The fear was contagion. Which bank was next? Which balance sheet had hidden problems? Which institution was vulnerable to a run? Credit Suisse was already fragile, so the market focused on it immediately. A bank can spend years becoming weak, but the final loss of confidence can happen in days. On March 14th, Credit Suisse published its delayed annual report and admitted material weaknesses in its internal controls over financial reporting. In plain language, the bank was telling the market that its own financial reporting systems had serious problems. The timing was brutal. A fragile bank, after years of scandal inside a global banking panic, was now admitting control weaknesses. The next day, the Saudi interview provided the spark. The room was already filled with gasoline. When Saudi National Bank refused to inject more capital, it was not only about the money, it was about what the answer signaled. Credit Suisse's largest shareholder had publicly drawn a line. Investors heard, do not expect unlimited support. Clients heard, the rescue may not be certain. Traders heard, the pressure is real. In a bank run, perception becomes reality. The statement did not create every weakness, but it compressed years of doubt into one brutal moment. Chairman Axel Lehmann and Swiss officials rushed into emergency mode. The Swiss National Bank offered a massive liquidity backstop. But the client withdrawals were too fast. Reports described outflows reaching about $10 billion per day. Imagine trying to refill a bathtub while the floor is missing. That was Credit Suisse in its final days. Money could be added, but trust was still escaping through every crack in the institution. The problem was bigger than liquidity. Regulators feared that if Credit Suisse collapsed chaotically, panic could spread across the global banking system. This was a global, systemically important bank. It had trading relationships, wealth clients, counterparties, subsidiaries, and financial connections across the world. A disorderly failure could become a contagion machine. So Swiss authorities stopped thinking like patient supervisors and started thinking like firefighters trying to prevent a city from burning. There was only one realistic buyer. UBS, Credit Suisse's old rival. The idea was almost unthinkable. For generations, Switzerland had two global banking giants. Now the government wanted one to swallow the other over a weekend. UBS did not want to inherit a disaster without protection. Credit Suisse had no leverage left. Regulators had no patience left. By Sunday night, the fate of a 167-year institution was being decided in emergency rooms, not shareholder meetings. On March 19, 2023, the shotgun wedding was announced. UBS would buy Credit Suisse in a government-backed rescue deal valued around $3.25 billion, a shocking discount to what the bank had once been worth. Shareholder voting rights were bypassed to move fast. The message was clear. This was not a normal merger. It was a controlled demolition. Switzerland was sacrificing one banking giant to protect the rest of the system. Then came the decision that stunned bond markets. Swiss regulator FINMA wiped out about $17 billion of additional Tier 1 bonds, known as AT1s, while shareholders still received UBS stock. Many bondholders were furious because they believed debt should rank above equity in a normal capital structure. The move sparked lawsuits and global controversy. Even Credit Suisse's rescue damaged trust because investors now questioned whether the rules could be changed in a crisis. The AT1 wipeout mattered beyond Credit Suisse. Banks depend on investors trusting the order of losses. Equity usually absorbs pain before certain bonds. But here the outcome felt inverted to many investors. Regulators argued the terms allowed it. Bondholders argued they were blindsided. The technical details became legal battlefield material. But the larger point was simpler. When crisis arrives, financial instruments that looked safe in PowerPoint slides can behave very differently in real life. For Switzerland, the merger created another uncomfortable reality. The country had rescued stability by creating an even larger UBS. One national champion disappeared, and the surviving giant became more dominant than ever. That solved the immediate panic, but it raised a new question. What happens when the rescue of too big to fail creates something even bigger? Switzerland had saved its banking system, but at the cost of concentrating it. Credit Suisse's collapse was not caused by one person, one interview, or one bad quarter. It was a long chain. Wall Street ambition, tax evasion, Mozambique, Spygate, Greensill, Archegos, Swiss secrets, client withdrawals, control weaknesses. Then the Saudi interview. Each event weakened the structure. Each scandal made the next one more dangerous. By the time the final panic arrived, Credit Suisse had already spent years teaching the market not to trust it. That is why the collapse feels so important. Banks do not sell ordinary products, they sell confidence. Their balance sheets may be complex, but their survival depends on a simple belief: clients must trust that the money is safe. Once that belief disappears, even enormous institutions can fall with shocking speed. Credit Suisse had capital, history, offices, clients, and government attention. But it lost the one asset no bank can print: trust. There is also a lesson about prestige. Credit Suisse was old. It was Swiss. It was global. It had survived wars, recessions, banking crises, and market crashes. But prestige can be a trap. It makes clients assume someone else has checked the risk. It makes regulators hesitate. It makes executives overconfident. The bigger the name, the easier it becomes to confuse reputation with resilience. Credit Suisse proved that a famous brand can hide a weak core. Another lesson is that risk culture beats risk reports. Banks can produce thick documents, impressive committees, and polished presentations. But if the institution rewards revenue more than discipline, the reports become decoration. Archegos showed hesitation. Greensill showed weak product oversight. Spygate showed paranoia. Outflows showed broken trust. The pattern was not hidden in one footnote. It was visible across years. The danger was not that Credit Suisse lacked warnings. The danger was that warnings stop changing behavior. For investors, the story is a reminder that cheap stocks can get cheaper when trust is gone. Credit Suisse looked beaten down many times before the end. Some investors saw a turnaround opportunity. But a falling bank stock is not like a normal bargain. If clients are leaving, confidence is broken, and regulators are circling, valuation can become almost meaningless. The question is not just, is it cheap? The question is, can it survive the next headline? For regulators, Credit Suisse became a warning about waiting too long. Authorities can monitor capital ratios, liquidity buffers, and recovery plans. But reputation can collapse faster than regulatory paperwork can move. By the time emergency meetings begin, markets may already have decided the ending. Credit Suisse's final days showed that modern bank runs do not require crowds outside branches. They can happen through phone calls, wealth transfers, social media rumors, and institutional clients moving billions before breakfast. For Switzerland, the fall was emotional. Credit Suisse was not just another bank name. It was part of the country's economic mythology: railways, secrecy, wealth management, global prestige. Its deletion from history meant something deeper than a ticker disappearing. It marked the end of an era in Swiss finance. The bank that once helped build the nation had become too damaged for the nation to let it stand alone. On May 31st, 2024, Credit Suisse AG was officially deleted from the Swiss Commercial Register. That sentence sounds administrative, almost boring. but it marked the legal disappearance of a banking titan founded in 1856. One of Europe's most famous financial names did not end with a dramatic explosion on a trading floor. It ended with paperwork, a stamp, a deletion. The quiet final act of a collapse that had been building for more than a decade. The fall of Credit Suisse leaves one brutal financial truth. Banks do not collapse only when they run out of money. They collapse when people stop believing the money is safe. Credit Suisse was built to finance Switzerland's future, but it died from scandal, arrogance, weak controls, and a culture that let trust bleed away year after year. In the end, the 5-word death blow did not destroy the bank. It only revealed what the market had finally understood. The fortress was already hollow. Thanks for watching, like, comment, and subscribe. If you enjoyed the story of the fall of Credit Suisse, how a 167-year-old banking giant collapsed, then you'll love the story of the BlackRock Empire, the company that owns everything. Click the video on your screen now, I'll see you there.